today, laughing or weeping, we're back. Hello again, it's Martin North from Digital Finance Analytics, World Notice Post, covering finance and property news. And Tarric Brooker's with me today. Hi Tarric, how are you going?
Pretty good yourself, mate?
Yeah, pretty good. I was a week late because I was away on holiday, so I apologise for that. But actually, timing-wise, given that we had the Statement of Monetary Policy today and the shenanigans of the last week, it's probably good timing.
It is actually, isn't it? I mean, the Statement of Monetary Policy was interesting, as it usually is. And as you say, there is a lot going on in global markets. You know, I wrote an article back in August talking about the potential for the rise in Japanese bond yields to spread into the global markets more broadly, into bond markets in particular, and put upward pressure on yields and, you know, create some problems. And that's exactly what we've seen.
Yeah, I mean, these bond rates, you know, the trajectory over the last couple of months is very significant. And it's not just a reaction, I think, to the Fed moving interest rates higher, although that's part of it, and of course other central banks. I think we should also understand the quantitative tightening programs that are actually going on. At the same time, of course, the Treasury in the US is swamping the market with more bonds. And of course, you've got the very unstable political background in the US, particularly with the speaker being kicked out and all of the things there about the debt ceiling. So to my mind, this is more than just a direct reaction to central bank land. It's something much more substantive. And of course, Australia is going to get caught out here because whilst our interest rates are a little lower than those around the world, we are definitely exposed to these higher bond rates.
We are, and I think, you know, that it's just worth noting just exactly how big the deficit is in the US and how that sort of feeds into the broader situation. Because we talk about, you know, quite a few times on this channel about burnout economics, and we've got, you know, Biden with one foot on the accelerator. You know, they're talking about a deficit of around about 6 and a bit % worth of GDP. Now, if you put that into perspective with, say, the heights of Reagan's spending in the 1980s, you know, when he was, you know, building up the 600-ship Navy, you know, throwing around tax cuts like they were going out of fashion, it's more than that.
Yeah.
You know, it's enormous. You know, we're talking about a huge deficit for an economy that is ostensibly booming on paper, because, you know, you've got the Atlanta Fed talking about, you know, 4% growth, you know, which is the annualized quarterly number. You've got, you know, an unemployment rate that it's down near the same lows not seen since man walked on the moon. And, you know, then on the other side of the fence, you've got Jerome Powell with his foot pressed to the firewall on the brake, trying to slow the US economy, trying to bring down inflation faster. And it's not really working on the timeline that I think he would like. So it's a real mess in a lot of ways. And the other thing that I think is interesting is that next year's an election year, so it's possibly only going to get worse and more interesting from here, shall we say?
Yeah, worse and more interesting, I think is right. And it's worth just thinking about the journey that we've had this year, right? Because at the start of the year, the expectation was that the US economy would go into recession, and then we would bounce back, and they'd have to drop rates, and that's why the markets were banking on rates would be up but then down quite quickly. And then we had the immaculate landing, soft landing, and then we had maybe it might not be, maybe it will be actually a bit more wobbly. But now we've got this very much longer, higher narrative going through, and as you say, the time frame over which now the Fed is thinking about potentially trying to sort of do stuff is extending. And I was reading a couple of commentators recently saying, well, we don't expect any rate cuts until at least 2025. So this higher rate environment, it is there for longer. But then this bond thing that's going on is going to put a lot of pressure on, for example, financial services organizations who fund themselves from the bond markets, as well as, of course, higher costs to all the government entities that are borrowing like crazy at the moment, as you say, through the deficits. So these pressures in terms of the higher interest rates are going to have a really substantive impact on the broader economies in many of these countries. So, recession probably is still not out the way, but it's being kicked down the road. And again, it's partly because the US is a lot stronger than everybody thought it was going to be, and that's partly because, as you say, Biden's stimulus programs were huge.
Yeah, I think that's definitely part of it. I mean, even just as you mentioned before, that rate cuts have been pushed out to 2025. If you look at the pricing for the path that the market sees for the RBA, they're not now seeing rate cuts until after March 2025. Now, personally, I don't see that as especially likely for reasons that we'll get into in the charts. But I just think it's interesting that is where we're at the moment. That we're in this higher for longer paradigm. At least from a narrative perspective. And what I feel is sort of on the horizon in that regard is that the more people believe that we're going to be higher for longer, the more bonds get hated, the more yields get hit. Sorry, the more that bonds get hit and yields continue to rise, I think the more likely that it becomes that something is going to break, something quite important, whether it's something in the financial system or whether it's an economy or whatever. And then you've got problems. And I think that, we've seen a very unique set of circumstances postpone the impact of monetary policy. I think that we've seen that in the labor market in the US. We've seen, what some labor economists have called, labor hoarding, with people, holding onto workers a lot longer than they perhaps otherwise would have. And that's because of the pandemic and the sort of fear for employers that they could be left without the employees that they need. And that's something that's very fresh in their mind. And on the consumer side of things, you've got people who are just still spending like drunken sailors because, that's what they got accustomed to during the pandemic. And, the YOLO mindset is still very much present.
Yeah, and it goes back to what we've said several times, that, of course, we've got a quite distorted economy with a proportion of the population still sitting on quite a lot of savings through those COVID handouts and things like that, and the fact they've got equity in their property, which gives them the motivation to go on spending. But you've got another proportion of the population that are actually really up against it. And it's interesting that, going back to that statement on monetary policy, they sort of conceded that there's around 20% of households that are actually now probably under significant pressure. But I will make the point that that's based on a series of out-of-date data that they're using, the Hilda data and things like that. So it's not very up to date. And it's interesting that they're saying, we don't know anywhere where we can find current information about financial pressure on households. Well, come and talk to me, folks. I've got some very up-to-date information which is showing significantly more difficulty in household sector than the official numbers are actually conceding at the moment. But this is a really, really important part of the story. So we've got more and more people falling off the back of the lorry. We've got other people who are doing quite well, and I think that's another reason why it's very complicated trying to work out what to do, because it's not everybody's in the same place.
No, and monetary policy just doesn't work the way it used to as well. I mean, just purely from a psychological perspective, monetary policy used to drive people to batten down the hatches, to prepare for what was coming next. Whether it was the impact of higher rates or the impact of a slowing economy, because they were accustomed to that, because it happened, sort of every, 5 to 10 years, depending on the decade or the cycle in question. And that was just a common thing that everybody just sort of understood. But these days, monetary policy doesn't work that way anymore. And especially we have this asset-rich, affluent, older demographic who perhaps either don't have a mortgage anymore, have a very small mortgage, who are capable of continuing to spend. And just a little interesting tidbit, like I was going through the wealth transfer report by the Productivity Commission a few days ago, and $108 billion a year passes as inheritances every year. And the overwhelming majority flow to people, I think it was 80% flow to people over the age of 50. Now, generally, those people were relatively thrifty. They wanted to save for their retirement. They wanted to, there'd be a holiday, they'd be, looking after the grandkids, maybe some private school or whatever. but it would be relatively contained. But in the world of, the post-COVID YOLO world, I would imagine that a lot more of that is being spent, and that is perhaps one of the reasons why we are continuing to see older demographics continuing to spend, even as the economy and even as other sources of income deteriorate for them.
Absolutely, yes. The intergenerational wealth question is definitely to the fore, and I'm continuing to look at some of the information from the Bank of Mum and Dad, and as I discussed in the previous show, it's not just parents, it's grandparents who are actually helping first-time buyers to get in. The latest data, which I'm just running at the moment, is showing about 1/3 of Bank of Mum and Dad recipients now are actually getting money not from parents but from grandparents. So it's probably part of that same story, in terms of actually all this shift around, all this affluence sitting up in the older age groups and sort of percolating down, not uniformly, of course, because you don't have rich parents, then you can't buy. It's a real mess.
So, what's the sort of proportion of people in total receiving help from, parents, grandparents, Tom, Dick, and Harry? What is the sort of proportion overall at this point?
Well, it's shot up from its lows. In fact, I'll put a chart on the screen so you can actually see it. It's rising quite fast. And the average value that's being handed down is also rising again. Now, it was falling previously. So we had a real big run up when prices were accelerating 2 or 3 years ago, then a significant drop, and now it's beginning to turn up again. So I think this is a very important factor, and it's quite complicated analysis to try and do, because of course it depends on to what extent disclosures are actually made by the people being surveyed, and you don't always get the full story. But there's enough there to suggest that this actually intergenerational wealth shift is really starting to accelerate again. And if you think about it, it doesn't make, it sort of makes a lot of sense, right? Because we've had significant equity creation over the last 2 or 3 years of house prices. They came down, they're going up a little bit now. We've had stock markets performing quite strongly, and we've got this intergenerational shift also as people think about perhaps downsizing. The government, of course, put the 300,000 capacity to down trade and put into superannuation down to a slightly lower age group, and that's, I think, another factor in there as well. So there's a lot of moving parts, and as a result of that, we are seeing more first-time buyers who, by the way, are ex-renters struggling to get out of the rental sector because of what's happening in the rental sector, looking to buy, and therefore, the families of those people and grandparents too are all offering to help, and that's one of the reasons why we're seeing some of the momentum we are seeing in the property market, I think, at the moment.
Yeah, I agree, and I think it's just worth exploring for a minute. Look, because I've got your data set going all the way back to the start with back to the early 2000s with the is it the early 2000s for the Bank of Mum and Dad one?
Yeah, that's right. Yep.
Okay, yeah, just because I know another one starts in 2010, but yeah. I think that's interesting, because if you look at the proportion of people receiving help, it was in low single digits back then.
Yep.
And now you're talking about 20% of people, and I went through your data relatively recently, and I think this is probably a couple of months old now. But I went through your data, and then I extrapolated that onto first home buyers more broadly. And you're talking about hundreds and hundreds of thousands of people who've received help from parents to get into the market over the last, you got about 20 years worth of data. And I think that it's interesting that if you look at that number, and then you look at the number that would have received help before, for me, it brings into question, this idea that home ownership amongst young people is going to surge in the same way it did for older people, for previous generations, because this time home ownership is being facilitated by people who have the wealth, the income, and the means to support their children or their grandchildren into a property. And that's not something that was as notable or as significant a driver before. So, you really wonder if the acceleration in home ownership that you see as people age is going to occur from, Gen Y and Gen Z for the same way it did, for, baby boomers and the elder members of Gen X.
Well, I'm pretty sure it won't, and there's a couple of reasons. One is that people are buying property later than they were you know, it's sort of often mid-30s or even later now to be a first-time buyer, whereas previously you would have actually done it a lot earlier. Well, that means that when you go, you know, as the age range continues and as time passes, you'll still have a mortgage as you come into retirement. So you won't actually have the same access to equity in the next sort of generation that you had previously, I think. And the other point, I don't think, and I could be wrong, but I don't think you're going to see anything like the capital growth in home prices that we had. I cannot conceive of the idea that we will have the same, 30% plus growth over the next 2 or 3 years of home prices that we had, so that the equity machine is going to be less powerful. And the third is, of course, that people are more leveraged. So if you look at what people are borrowing today to get into the property market, it's still a debt to income ratio much higher than previously. And interest rates are also higher as well. So it's going to cost a lot more. And so all those things together suggests, in my mind, that we are going to see a rather different evolution of intergenerational wealth in the next generation too. The thing that also is here, of course, now is this strong migration. And this strong migration could also, again, mess with some of this dynamic. So I think it's unlikely that we're going to see the same trend as we saw in the last 30 years.
Yeah, it's going to be interesting because, obviously much of the rise in housing prices over the last 30 years has been facilitated by lower interest rates.
Yep.
Now, when rates are eventually cut here in Australia, obviously you will see that to some degree, because although really it's going to depend on, and this is something that Cameron Murray, I think, has covered quite well, just that it's going to depend exactly where the property market is in terms of its settings. Because right now, if you look at property prices, they are not reflective of a benchmark average variable mortgage rate of over 6%.
Yep.
That's simply just not the case.
Yep.
And that's something that even Peter Tulip, Christopher Joy, all those guys, they've covered all this to varying degrees. And, so it's going to depend on exactly where property prices are, because where they are now, as I said, is just not reflective of where rates are at. So, you can't. I think it's interesting because on one hand, the argument is often made that interest rates are being cut, that's good for property. Interest rates being raised, that's good for property. And it's just like, well, I don't know. I just think that we've got a situation at this point where the market is being supported by some rather different factors to the normal sort of rate cuts and perhaps, say, in decades gone by, wages growth factors that we've seen in the past. And in today's terms, the reason why the market is up and the reason why the market is being supported is because listing volume, total listings have collapsed. And if you look at them in per capita terms, it's even worse. Yep. You're talking, capital city listings are just absolutely in the toilet. And if you want to, and also migration has been turned up to 11, and you've got all these people, as you mentioned previously in your surveys, who are renters who just desperately want to get into the market and are willing to just get whatever they can get their hands on because it's better than the alternative. And to be completely frank, that's a perfectly understandable set of choices.
Yeah, and just on that last point, again, I've been looking at my data quite carefully because of this issue and trying to decode the aspirational renters. In other words, the renters always say, well, of course I want to get a property, right? From those who are proactively trying to find a way to do it sort of in the relatively short term is actually quite complicated, because there are a lot of people when you survey them and they're in the rental sector will express concerns about the insecurity of where they're living, the fact their rents have gone up dramatically. In some cases, they've had to move recently. And so they say, well, obviously, I'd aspire to get into a transaction that I can buy something, right? Now, that's a big number. But when I looked at the data more closely, I started to realize that aspirational number wasn't actually translating into those who actually were buying. There's actually a smaller proportion. And that's simply because of the economics now. If you don't have help from the bank and mum and dad in particular, the ratios at which you can borrow and the serviceability buffers calculations that the banks are using are precluding about 2/3 of those aspirational renters from doing anything. So the actual pure number of people who are in the position to transact and move from rental to purchase is a lot lower than my top level numbers when I started looking at this a couple of months ago has actually turned out to be. And that's because of the difference between aspiration and reality based on the economics that you can actually get to see in the real world at the moment. So it's quite an interesting dynamic. And again, that's a bit unusual.
No, that's really interesting to hear, because I mean, obviously, the thing is, property turnover in Australia is so low. At the moment, you're talking about less than, I'd say it's probably about 4.5% worth of, a 4.5% turnover rate for the overall market. That's just sort of a rough estimate, but that basically means that most property only turns over, less than once in every 20 years. So, if you inject even a little bit more demand from, say, renters who are in a bad spot, then that demand can have an outsized impact on the property market, particularly at a time like now where listing numbers are so low, are arguably artificially low due to the pandemic and never recovering from that. But I do wonder that, is there any sort of sign in your data that particular demographic of potential buyers is slowly being exhausted?
Yeah, it goes back to what I said. The aspiration is strong, but the proportion who can actually do something about it is shrinking. And that's because with higher interest rates, with real incomes going backwards still, with the expenditure measure ratios changing as the cost of living are rising, it means that less and less of that pool is able to do anything about it. And in fact, what they're now doing is they're turning to other strategies. So the other things that have come thematically through in my surveys in the last quarter is, firstly, moving back with parents. That's actually now starting to grow quite strongly. And the other one, which I thought was quite amusing, the old theory of granny flats. You sort of build something in the garden for your parents. Well, it's turning around. We've now got some people saying, well, why don't we build something small, a granny flat thing, for our kids? So we're starting to see those emerging strategies. And that's because it's impossible for a lot of these aspirational purchasers to ever get into the property market in the current environment. Yeah, no,
that's certainly the case. And you've even seen, Dan Andrews, just before he retired, coming out and saying things like, what was it? Permitless granny flats under 60 square meters in the backyard and all this other stuff that because the politicians are all clutching at straws. And I would just say on the Dan Andrews thing, don't take that as gospel. Just be careful, because councils can be a real pain in the ass if you don't get the right permits.
No, that's true. But no, it is interesting. So, I think the net conclusion from this conversation is that the property dynamics are changing. And some of the reads across from the previous generation probably aren't that relevant. So it's really important to look at the current data to be able to actually decode what's going on. And that's why I'm very concerned that the RBA seems to be relying on Hilda data from 3 years ago when they actually comment on affordability.
Yeah. All right. Well, before I say something that gets us into trouble, we should probably get into the slides.
Let's go there, shall we?
Okay. As usual, the slides will be available at avidcom.substack.com, and where possible, I will link to the original source. Any help in this would be appreciated. If you want to donate, subscribe, have a paid subscription, that would be absolutely wonderful, and it really helps me just put more time into this and, keep up with the chats, the articles, and everything else. So, and thank you to all who have already done so. That is very much appreciated. So we will get into the slides. Now, this is from the RBA's Statement on Monetary Policy, which came out earlier today, which Martin just mentioned. And I think that there sort of needs to be a bit of a caveat placed on these charts, because it is based on the household expenditure measure. Now, the HEM, as it's known, is based on a basic standard of living, the most basic standard of living, and it assumes that a household has discretionary expenditure at the 25th percentile, aka 75% of households will spend more than this household. Now, I don't know many mortgage holding households who are not in desperate strife who are in that particular category. It also assumes some other things like these analysis also assumes some other things like not having any other debts and a few other things that make them a little bit unrealistic. But even with those caveats, even with the fact that there is that particular sort of disclaimer attached to it, 13% of variable rate borrowers have a cost of living that exceeds their income. And that's quite a lot.
Yeah, and it's worth just adding a couple of points there. Firstly, of course, they're looking at the securitized pools. So these are not necessarily bog standard mortgages. These are the ones that are actually put within the securitization pools, and they tend to be better, higher quality than average. And the second, it's interesting that they're talking about cost of living exceeding income, which is of course the way that I've been doing mortgage stress for years and years and years, right? So I've talked about cash flows, right? And my cash flow measures would suggest that about half of mortgage holders now have a cash flow deficit. So I'm looking at maybe a slightly different way, and I think it's because the HEM is a very inefficient way of trying to measure what people are actually spending. Of course, people are spending more than the minimum. And as you said a little while ago, the HEM is a very, very basic lifestyle. Most households in my surveys are not actually spending at the HEM level, they're spending more. So that's why this is a bigger problem than perhaps they want to recognize.
Well, yeah, and I think that the HEM thing, I've spoken to quite a few people. It's not terribly realistic in today's world. And I mean, I think the thing as well is that if you are someone who has had the ability and the income to qualify for a mortgage, you're already doing better than probably, a sizable proportion of household, if not slightly above the median these days. And you don't see many households in the with discretionary expenditure in the 25th percentile because, you're not really that far above the sort of pension holding retirees, the disabled, and all that. There's a big gap between sort of 25 and 35 and 45 and 50. There's a huge gap in there. And yeah, I don't really see it as all that realistic. And I think the thing is that, like, I realize that there is a Spartan lifestyle that one can have that, that is the, we'll call it the HEM lifestyle. And people have higher standards than the HEM and higher standards than I do. So I think that, people could find themselves in trouble and just not able to really get themselves out of it without making sacrifices that they perhaps are unwilling to make. So I think that's going to be an interesting one going forward, because at this point, I don't even think it's about the rates going higher anymore. I think we're long past that. I think that the biggest issue now is time. If rates stay high, households are going to struggle. People are going to go into arrears, and they're going to get into serious difficulty. This is a point that I think Chris Joyce made quite well recently. But that's going to take time. People can, beg, borrow, and steal, and do whatever they have to do to buy time. And I think, that's what we're exactly what we're seeing right now.
Well, I absolutely agree with you on the time issue. People were, until quite recently, holding hope that rates would drop again, and that effectively we'd be coming back down to 1 or 2% cash rate, and therefore mortgage rates would drop. There's now a growing realization, a growing creeping horror that actually no, we're stuck in this higher rate for a lot longer. The other interesting observation is that we're starting to see now a rise in credit cards, in terms of debt on credit cards, and we're also seeing a rise in buy now, pay later. So people are actually using other debt means to try and get by. And the trouble is with that, you can do that for a little while, but not for forever. And then the third is that some of the things that people are not doing in terms of spending, things like not spending on dental treatment, for example, is a big one that I see quite often in my surveys, means that you actually are building up problems for later, because if you do have dental issues, but you don't have them fixed, then you've got a bigger problem later. So, the time element on this, I think, is the critical question now. And that's why I get a bit frustrated with some of the public commentary that I see from some economists who just have no idea what it's like to be in a situation where effectively you're underwater, and you're underwater, and you're trying all the time to sort of balance and juggle the finances to get by. They've got no idea. And the trouble is, we've got lots and lots of people now, not uniformly spread across the country, but in a lot of those hotspot areas, who are really up against it. And I just don't think that the social consequences of this are being discussed, nor are being understood.
No, I think that there is quite a bit of look at arrears, therefore everything is fine. It's like, well, you don't know the sacrifices that are being made for those arrears to be maintained. I mean, the RBA themselves said that, a 3.6% cash rate, that 15% of borrowers would be in, spare negative cash flow. That was their own finding, and those people are struggling. That is a fact, but the problem, I think, is that, it's easier just to say, things are cool, things are fine, arrears are low. But I think below the surface, there is a lot of difficulty. And I think it's also just worth noting that the issue, I think the thing as well is that there's sort of like this almost like Big Short-esque view of the way that the property market in Australia functions, that there needs to be all these arrears and all these foreclosures and defaults and stuff for there to be, a downturn, for there to be difficulty in that regard. But I don't think that's the case. What we've seen more recently is that the market has been supported by low volumes, has been supported by the additional demand from migration, from the rental crisis, from a bunch of other different factors. But for a lot of people here in Australia, particularly people who've got a mortgage that's, say a couple of years old, even from 2017, 2018, for a lot of people, even if they're up against it, even if they're not going to make it in the long run in terms of, paying their mortgage, there's still a lot of equity there because of the pandemic and because of this latest run up in housing prices. And those people can still walk away. And if the rental crisis does abate, and perhaps, if you're in an area where renting is relatively affordable, or perhaps significantly more affordable than paying the mortgage, perhaps that might be an attractive option down the road. Although, it just depends on what the Albanese government does with the immigration lever.
Well, they're not going to trim it back, are they? I don't think at the moment. But the interesting observation there is that if you've got equity, the banks are very willing to refinance and to allow you to pull equity out to cover your mortgage repayments for the next year to 18 months. So that's one of the levers that's definitely there at the moment, as well as the idea of extending the term of the mortgage or going interest only. We've talked about extend and pretend before. That the banks are absolutely paranoid about keeping the arrears rates really low. And they're doing a lot of things below the waterline to help. And it is interesting to see in my surveys how people who are in a stressed position are still getting help from lenders to be able to sort of muddle through for a few more months. I guess the question, Tarric, is to what extent that can continue. Will there be a point at which, the elastic has just been stretched so far, and then does it snap? Or will we actually see interest rates come down and provide a bit of relief that way? Because I don't think we're going to see real incomes grow that much at the moment, although inflation is, wobbling around a bit. So the extend and pretend story, I think, is part of this picture as well.
Oh, 100%. I spoke to mortgage brokers. I've spoken to other people in the, financial services, and that's what, that's what they're seeing. They're seeing that particular struggle. But it's going to be interesting going forward just to see how it all plays out in reality, because I think that Australia really has a problem. Actually, you know what? We'll get to. Well, I'll explain. I'll get into that with some of the slides. So I think we should just get on to the next one, and we'll get to that.
Let's go there.
Okay. I just put this together for an upcoming article. It should be out over the weekend. on news.com.au, and basically it's what happens to housing prices the year after rate cuts start. And generally, it's not a good thing. And the one exception to this is the 1983 rate cut cycle. I've only included rate cut cycles where inflation has been high. And when I say high, I mean higher. Proper rate cut cycles where inflation is like significantly above the decade average. And some people may say, why is 2000, 2001 and not in there? Because that was caused by the GST, by the introduction of the GST, and doesn't really apply. But it just goes to show that people may may want to be careful what they wish for in terms of rate cuts. They may get them, but the question is, what are the conditions that are going to occur to underpin that situation?
Right. So the read is that when rates start to get cut, house prices perhaps descend. Perhaps.
I mean, in all these instances, unemployment rose significantly. Yep. So, I think that it is, however, worth noting that one of the reasons why housing prices took off in 1983 is because the Hawke government introduced a first home buyers grant that was almost 9% of the median Sydney house price. So, and that's not dwelling, house price. So Bob Hawke basically gave anyone who wanted it, any couple who wanted it, who was eligible for it, almost half the deposit. Bang, there you go. And this was also a time of very, very strong wages growth. So that's why housing prices absolutely took off at that point. And it's also the fact that back then you could save up your house deposit in about, 2.5 or 3 years, and it was all relatively cheap. Well, compared to where it is now anyway.
Right. So it shows you that political intervention, I was going to say something stronger, but I'll just say intervention. Political intervention in the property sector is not new.
No. And I will just add one more thing to the commentary for this chart, and that is that prices fell in Sydney, Melbourne, and Perth. Now, you look at it and you go, well, that's not so bad. But the real hit to this wasn't actually the fall in prices. It was the fact that for Sydney and Melbourne in particular, prices stayed low for years. So, prices in Sydney didn't recover until 1995, until Melbourne in 1996. And the early to mid-90s was a time of very strong wages growth. So there was a time in, I believe it was 1996, where on a single average full-time income, someone could buy a house, buy a starter home on that single income relatively easily. And the total cost of servicing that mortgage was under 30% of their gross household income. You throw in, the wife or the partner getting a part-time job, and it was completely doable. And well, it's not like that anymore.
The world has changed. Prices, and just to be clear, on a relative basis, prices are 40% over where they should be if you actually go back to where things were then, right? Now that 40% is driven partly by the higher debt-to-income ratios that banks are prepared to lend at, plus, of course, the low interest rate cycle that we had and the significant equity buffers that were created because of it. But that's artificial, and that's why I keep saying to people, and they say, oh, you keep saying property prices are going to fall. I said, no, you got to understand. Over long-term trends, we are 40% over where we should be. Now, there's a bunch of reasons why we're 40% over, including all the government intervention and migration, etc., etc. But if you were to trend back to mean, you would see prices drop dramatically.
Yeah, it's going to be interesting. But let's just say that. Now, this is what I was talking about in terms of like my sort of concern for Australia: monetary policy, the economy, the labour market, you name it. This is sort of one of the big roots of that concern. Since October last year, the labour force has been growing faster than the labour market is creating jobs. And that's concerning because it means that unemployment is rising. It's rising relatively slowly, and you've got to look at it in trend terms and not the seasonally adjusted number, which is noisy as, but it is rising. And that's quite concerning because the economy is still doing very well. And I'm just going to go to the next chart. The job openings as a percentage of the labor force are absolutely still on the moon and consistent with much, much higher levels of jobs growth than what we're seeing now. So my concern here is that the job ads indices, the ABS job vacancy data, that somehow, for reasons that I don't fully understand, is creating a picture of the labor market that's stronger than it actually is, at least relative to the growth in the labor force. And my concern is that even if we just see a slowing of jobs growth to say the 5-year pre-COVID average, we could see, unemployment above 4% by, sort of early to mid next year and pushing up towards 5 by the end of next year. That is a possibility without there even being any jobs lost. Now, if you see a true deceleration in the economy and we actually start to see jobs being lost, then you could see a significantly greater acceleration if the current level of labor force growth is maintained into the future. So my concern is that we're going to get close to the RBA's target for the rise in unemployment, and they're going to be put in a really, really bad spot as to what they're going to do, because if inflation is still high and the main reason that unemployment is rising is simply because the Albanese government is continuing to run migration at a faster rate than the labour market can produce jobs, they're pretty well trapped.
Well, absolutely. And the point about the employment number is, of course, everyone's been saying nothing problematical with the mortgage portfolio because everyone's got a job, right? But if in fact the unemployment continues to tick up, you might well find some substitution going on. So, if you're bringing a lot of people into the country, maybe they're prepared to work for lower wages relative to those who are already employed. And so you might actually find a bit of rotation going on. And some of those people who were employed then are not employed. And those are the very people who have mortgages. And as everybody knows, that if you are out of work, then those mortgage repayments are impossible. So this is a really complex situation now, and it's still being created by this massive migration. So to my mind, it's the migration problem writ large again, and all over these numbers.
Well, my concern is that, and my theory is that by the middle of next year, we will see the RBA cut rates at least once. I think that the labour market will decline to that point, whether it's driven by solely domestic issues or just slower job creation. I know that, that's a sort of a fairly big call and it's fairly out of consensus at this point, but my theory is that they're heading for that point. And, the idea for the RBA is that in a lot of ways they are trapped, because if they cut rates, it's going to put they're going to hammer the dollar relative to the US dollar unless something deteriorates on the US side of the ledger. So that they are really quite in a pickle in that regard. And I'm not sure what exactly that they realistically can do, because this is beyond their ability to control. It's in the hands of the federal government, and they've chosen to pursue this strategy.
Yeah, and it's interesting. Did you see Warren Hogan the other day saying, there's a big difference between what the RBA is doing and what the Fed is doing. The Fed is being much more proactive. The RBA is being, I think he sort of suggested, reactive. And, it sort of suggests to me that they either don't have levers, or they don't know what levers to pull, or they've chosen not to pull levers and just waiting to see what happens. But the trouble is that all of those externalities, and I think the exchange rate's a really important point to highlight. With the lower exchange rate, we are importing inflation. So there's a real problem if the exchange rate continues to go low. It's going to actually bring greater inflationary pressures back in, which means that they may well have to lift rates. And in fact, there's some articles out recently suggesting that one of the reasons why the RBA will have to lift rates is because of the low exchange rate, which is unsustainable.
Did you happen to see the latest press release from Deutsche on their RBA rate outlook by any chance?
I had a quick look, but you might want to just recap it because it was quite interesting.
Yeah, so basically, Deutsche sees two more RBA rate rises this year. So that's in November and December, quarter point rate rises. But one of the reasons that they see that is that they, according to the RBA's statement on monetary policy, at the low end of the income scale, in the lowest, I think it was quintile, so the lowest 20%, that they have seen growth in their incomes of around about 10%. Which is significantly greater than wages growth. And it's not the fact that they are earning more per hour, a lot more per hour, I should say. There's still, there are some enjoying some quite decent wage rises, but it's more the fact that people are taking on greater hours and taking on additional work. So there's a good chart from Alex Joyner at IFM who posted that basically there are a larger proportion of people working multiple jobs now as a percentage of the labour force than at any time since at least the mid-1990s. So the argument that Deutsche make is that basically incomes are still rising significantly faster than they should because of people taking on all this extra work, extra hours, etc. And that should be what the RBA is looking at, because ultimately that's what drives inflation. Aggregate spending, aggregate income, that's what drives it, not the wages price index, which in fairness to them is perfectly logical.
I think that's a very important point. And, the ABS data earlier on also showed this increase in hours and increase in multiple jobs. A lot of those multiple jobs were women, and a lot of them in part-time work. So that's a signal of distress rather than prosperity. People are forced to work more hours, forced to work more jobs just to get by. That's what's happening. But it's not necessarily good news for anybody, really. And, it is fascinating when you actually look at some of the other commentary suggesting that the RBA has basically allowed the cost of goods, which went up and has come down, to really govern their strategy. And this other stuff that we're now talking about, well, they haven't really done much at all about it. So that's one of the reasons why people are saying, well, the RBA is really just sitting on the sidelines and just watching what's going on.
I think the thing is that the RBA strategy made a sort of sense at first. If you look at, say, for example, where we were at, and let's call it sort of November, December last year, the sort of consensus was that there'll be a US recession, that rates will come down, that, maybe even something will break and there'll need to be QE, and all that was a sort of relatively middle of the road sort of viewpoint that, those were strong possibilities. But that obviously hasn't happened. And, the US economy is still performing decently enough. There's some cracks appearing here and there, but it's nothing major just yet. We'll have to see what the jobs report, which is going to be out later tonight, has to say. But the strategy made sense. We'll just, sort of trail the Fed a little bit, and, we'll do what we need to sort of make sure the dollar really doesn't go down the toilet, and to sort of, do what we can to fight domestic inflation, but we'll, take a sort of more softly approach than perhaps others like the Fed or the RBNZ have. And that strategy made sense. But if you sort of think about us sitting here in 6 months' time and the US economy is still going okay, that strategy is going to look pretty stupid, and it's going to look, pretty short-sighted, and that they could have done more and they should have done more. And that sort of brings me back to something that you and I have discussed quite a bit, that the longer this economic cycle goes, the worse it's going to be, and I know that seems sort of counterintuitive in a lot of different ways, but if something just breaks and the Fed and the RBA just unleash lower rates, and that, we see fiscal stimulus and everything is just basically a rerun of, whether it's a rerun of 2008, 2009 or a rerun of 2020, 2021, that is basically the easy way out. But if things sort of deteriorate over time and things really start to get more challenging in the labor market, more challenging for businesses in the long run, that, I think, is the scenario that people need to be, more concerned about, to be completely honest with you.
Well, I've been talking about the long grind. So in other words, what happens if we don't have, something break at the edge? They sort of muddle through for a longer period of time. these higher interest rates putting more and more pressure on households and on businesses. The number of business failures probably continuing to rise, the number of households who are in difficulty continuing to go in that wrong direction, but not a real turning point created, because nothing actually drops off the lorry. It just sort of gets tighter and tighter, and this could be a 2 to 3 year period of extreme discomfort for many people. And like I said in the title, you either laugh or cry, right? Because you either say, wow, it's a joke, or you actually start feeling really sad about what's going on and the pressure on households. I can't see necessarily, unless there's a big external shock, and that could be the US or maybe China. But if we just muddle along with the trade balances that we have, etc., this could muddle on for 2 or 3 years.
Well, it could, and I think that could be one of the real nightmare scenarios for Australia, because if we do muddle along, if things just go sort of okay-ish, our economy is not equipped for that, put simply, because if rates stay high or go even higher, as Deutsche and others have suggested, the construction industry is going to continue to suffer. Eventually, that pipeline of work is going to dry up, and you're going to see issues with rising unemployment in that particular sector. And then, by the same token, you're going to see all these, the 14.6% of households that the RBA say don't have the means to pay, to basically pay their mortgage on a long-term basis once they exhaust their buffers and etc. They're all going to be in trouble. So, in some ways, that is, that followed by the inevitable damage that would do that's probably the most nightmare scenario of them all. I mean, well, shall we say the most reasonable nightmare scenario of them all? There's obviously, something insane breaks and then, Great Depression 2.0, but that's not very likely, thankfully.
Right. And then just overlay that with the election cycle. It could get quite interesting.
Yeah. Well, that's the problem, isn't it? I can't really see Biden stopping, or whoever the people have been accustomed to handouts, have been accustomed to the big spending, and it's just been ramping up since Reagan, really. So there's that problem, and there's the potential for that to be inflationary, for that to extend the cycle, and that the problem for us is that extends the US cycle. It sends US rates higher. Yet if Albo turns around and does that, that's going to weaken the dollar, and we're really stuffed. Yeah, that's a good point.
Yeah, I think it's worth just factoring into the storyline. We are in a weird situation where a lot of what happens in Australia is going to be influenced by what happens in other places, which actually is an interesting observation. And yet we've still got this massive migration lever, as you say, turned up to 11. That has got to be questioned. To my mind, we should be having a much more active debate about, is this really sensible, with everything we know now, with everything that's going on, because I think it's the wrong strategy. What
I want, ideally, and I realize the Rolling Stones say you can't always get what you want, but ideally, I would like to just see the debate brought back to numbers.
Yeah,
just pure numbers. Let's take all of the various emotionally charged aspects out of the debate as much as humanly possible. And I realize how difficult it is with a topic that is, at least in Australia, as emotive as it is. Now, to what degree that's deliberate, we will let the viewers decide. But I think that what we need to do is we need to have an approach to migration that is outcome and data and statistic driven. Do we have the housing? If we do have the housing, where is it? Do we have the jobs? Are we going to create enough jobs for migration not to put significant upward pressure on the unemployment rate? And to sort of take a very data-driven approach to what level of migration is sustainable in Australia. And I think that would be fair. I think that we just need to be realistic about it as well. And I think that, to be completely honest with you, there have been a lot of groups, I think, who have been unfairly scapegoated by the migration debate, for example, like by the end of last year, you already saw that the number of temporary visa holders had risen above the pre-COVID level, and that had already occurred to a fairly significant degree. Yet, if you go look at the granular data, the number of international uni students still hadn't hit the number that it was prior to the pandemic. You look at the number of skilled employment visa holders, that still hasn't recovered. Even now, even with the latest data, which just came out for August, that still hasn't recovered. So this idea that it's all just being driven by, oh, well, we're bringing in all the doctors, all the nurses, all of this, all of that, and it's the students. No, that's just not the case. Maybe I'll have to do a granular breakdown to sort of show that, some of the misconceptions about it. It's not just people coming back and resuming their studies. There's more to it.
I think it will be very valuable to Tarric because I've been looking at that same data and drawing some of the same conclusions. There's something much more significant going on here than the general tone of the commentary so far, which frankly has been relatively naive, I think. So I think there's a job to be done. So you might want to sign up for that.
Yeah. No, I think it just needs to be made out that it's a choice by the Albanese government. They're very much making it, we're just doing what we have to do and blah, blah, blah. And look, I completely understand that, that international students want to come back and resume their studies. I would want to do that too. I totally get that. And I also understand that there are certain skilled professions in Australia, like doctors, like nurses and midwives and all these other different professions that we do need to a rather, significant degree. But is that what we're actually getting? Is that what is driving this surge? And put simply, the answer, is no.
I agree. And I think in the current environment with this idea of, longer term stagnation, we should be definitely having this debate. So I agree. It's a debate that should be had, but it should be informed by data.
Yes, very much data driven debate.
Yes, please.
We hope. We hope. Okay, now this is from a very interesting paper by two senior folks at the RBA, which I found quite interesting. And basically it finds that government defines the impact of government-defined skill shortages on wages growth is basically not far off a rounding error. So either the Australian labour market is desperately broken, which is admittedly possible, or the skill shortages aren't as desperate as they're made out to be.
And that's a very interesting observation, isn't it? Because, of course, the official narrative is we need all these people, right? And, of course, big business keeps saying we need all these people. And I've always had the theory that the reason that they want these people is because they can actually pay less in terms of wages than actually Australians. So there's more, again, going on than the official narrative would actually want to recognise, I think.
I think that it's a bit sad, really, because I think that there are professions where we need the help.
Yep.
Where particularly in sort of vital services, but then they're lumped in with a bunch of other professions where, frankly, we've got more than enough of. Like, do we? Some of the professions on the list that are required are things like chefs and cooks. And yes, those two are apparently separate things because reasons. And accountants. And it's like, do we really need more? Apparently we do. And, then you see, articles in the AFR about these accountants and engineers and everything else ending up driving Ubers.
Yep.
And it's like, well, if we needed them so badly, and then why aren't they in work? So I think there's just a lot of questions that need to be answered. But, I mean, then there's also the Albanese government's review into migration, which found that basically the system is completely broken. And that even, I think that they said that, I think one of the conclusions of the report authored by Christine Nixon was that, even things like human trafficking rings were allowed to operate with, and I quote, impunity I mean, Jesus, that is just horrible. You know, that the people are being exploited in our country in such a horrible, horrible, horrific way. And, you know, these failings are known about and not addressed. And, you know, people at, you know, the Department of Home Affairs and elsewhere have been raising these issues for years. And it's just sad that it's continued just, you know, because reasons. I don't know. I don't really understand it, you know, but I mean, I guess I'm a human being. What would I know?
Well, two quick observations. Firstly, of course, the Labor government's job report or job strategy came out quite recently, and they wanted to define employment differently, right? So, you know, everybody who wants a job can have a job, and we're going to define it differently. Which I mean, it's talk about moving the deck chairs on the Titanic. But the other thought I had was that, I don't know whether you remember The Hitchhiker's Guide to the Galaxy, but there's a wonderful bit in that where they landed on a particular planet and discovered that years ago, all the hairdressers and, you know, a few other hangers-on advertising executives were all shot across to this planet because they wanted to get rid of them all, right? Because they realized they were actually not very productive, right? They weren't needed. And I have a feeling that some of the stuff that's going on at the moment is that we've actually got people with skills that are actually in less demand than might be actually said. And, you know, it doesn't necessarily help. And of course, the Hitchhiker's Guide to the Galaxy ended up with them not being able to actually survive because, you know, well, hairdressers and marketing executives were great, but they weren't very good at surviving. So it makes you think.
Yeah, I just think it's sad, you know, because like there was a recent report done into migration in Canada, which has a relatively similar system to Australia and some similar issues as well. But, you know, this was a United Nations report on just basically how exploitative the system in Canada was. And I think that, you know, if they were to author a similar report on Australia, it would come to, you know, relatively similar conclusions. And I think that that's just, it's deeply sad because, you know, migrants are being sold this life in Australia, you know, this, you know, sort of, you know, beachside living, you know, lovely, you know, affluent, positive life. And a lot of them are getting something completely different. And that's just, it's just sad because there was a time when you could do that. You know, like I think about, you know, even, you know, sort of family friends who came here from Greece or Italy or Lebanon or, you know, Vietnam or wherever, you know, people who live, you know, walking distance to the beach in a nice house who worked hard all their lives, you know, and it's not like that anymore. You know, it's a very, very different world. And, you know, and in some ways it's, I mean, I'm not going to say it's harder, but it is harder, say, for example, for some educated people. And it's just ridiculous. But I mean, there's a reason why you and I don't make immigration policy, or should I say just sensible people in general.
Well, I arrived in 1994 to Australia, and I was amazed at the openness and opportunity that there was when I arrived. And, you know, I had a great time there. But when I came back to the UK, one of the things I did was to make some comparisons of the relative costs of things between the UK and Australia. And it's actually amazing. It's cheaper to live in the UK than Australia.
Really?
Yep.
Unreal.
Whether you look at food costs, insurance costs, fuels roughly line more, but even, you know, power and, you know, those sorts of things, electricity. I'm actually living cheaper than I was in Australia. It's amazing. And that was a complete turnaround. I was surprised how different it is. So there's something gone wrong with the great Australian dream, I think. And I fear that some of those people who come into the country are being sold something which is now just an illusion.
Yeah, just on a sort of, you know, this is sort of more of a personal note, just a question, but do you find that people in the UK are different? Are they friendlier than people in Australia? Because I feel like over the years here in Australia, like we've gone from being like a very friendly, very open place to just, you know, sort of like everyone's just doing their own thing. Everyone's just trying to get by. And that's just sort of, you know, like I remember going to the States and just being like, what, you know, this is just, it was quite jarring, you know, having people like, you know, hey man, and, you know, just being like, you know, talking to you and just, And I just find that, like, I mean, it's still like that out in country Australia, and that's why was one of the reasons why country Australia is so brilliant. But is it different? And do you find it's different in the UK in that regard?
Well, it's interesting because I lived in the centre of Sydney for a long, long time, and then moved down to regional Australia. And people in regional Australia were much more friendly and open than in Sydney. I mean, Sydney was, it was unpleasant actually, and it was the sort of the push by and just get on with your own life and never mind anybody else. Now in the UK, and again, I'm not in London, I'm in sort of southwestern England, which is perhaps a little more laid back. But no, I found people way friendlier than I expected or even remembered. So it's actually a very pleasant environment at the moment. And whilst the economy here is not doing great and there's lots of issues, etc., I'm not seeing the same sort of spiral of negativity that I found in areas of Australia. So I do feel that what it is that's changed, but something has changed in Australia, and whether it's simply the economic environment or whether it's something else, I'm not sure. But yeah, it's quite a weird. It's when you stand back and look at it externally, you maybe get a different perspective, and that's what I've been able to do.
Yeah, I find that one of the things that we sort of do sometimes in Australia is we look at things and we go, well, our incomes are X, our net worth is Y, and ergo, therefore, we have livable cities and all this other sort of stuff. And it's like, okay, yeah, sure we do. And don't get me wrong, there are parts of Australia and even in some of the cities which are absolutely fantastic. But the life the sort of Harbour Bridge and, the Opera House and all this sort of, stuff, and everyone's, 15 minutes from the beach and all this other nonsense, when in actual fact it's sort of more, when the more sort of median lifestyle is the urban heat effect, parts of Western Sydney. And I just find that, that is sort of, like, it's very much quantified by money, by wealth, by all these different things. But then when you look at, say, like international happiness indexes and things like that, some of the happiest people in the world are people in Latin America, which are constantly dealing with, governmental and economic fusterclucks. And I just feel like, we sort of need to put a greater premium on outcomes, on, mental health outcomes, on happiness outcomes, and all these different things, rather than just people are worth more, incomes are worth more, but, not enough attention is paid to what those incomes and actually buy you and what life that buys you in modern Australia compared to perhaps, the way it was in years and decades gone by.
Well, it goes back to this fundamental question: what's an economy for? Right. That's actually the key question. And if the economy is ultimately to turn the handle and create more stuff in terms of economic outcomes for the government or whatever, that's one story, right? But actually, to my mind, it's about life and lifestyle and those sorts of things. And I think sometimes that the decisions that are taken by politicians and others are so myopic, and they're not actually thinking broadly about what's an economy for, what's life for. And to my mind, the economy should be serving its people rather than the other way around. Yeah, no, I would just, like, I mean, I'm not even going to really call Labor's well-being budget an attempt at that, mostly because it was crap. Like, some of the data in that was so outdated, it just wasn't funny, and it missed so much. Spot on. Like, literally data that, I mean, like, I could have done better. Yep. I literally have the data, the graphs. So, give me the couple of $1 million or whatever it probably cost in, Treasury's time, or whoever put it together is, whatever it ended up costing the government. But I do think that that's something that we need. We need a data-driven approach, an outcome-driven approach to governance, to economics, to what is this actually achieving? Not just GDP number go up or housing price number go up. And I think that that's just a fundamental problem with modern economics and modern governance and just the way things are approached in this world, because, number go up doesn't really mean anything. And that's one of the reasons why, you've seen the rise of Trump, the rise of populism, because people feel like the government has failed them. I mean, even in our own Australian National University election study that for 2022, 70% of people believe that the government is run basically for themselves.
If it's run for their interests, not ours. And when you've got such a large majority of people who believe that, that's quite concerning, because it's the relatively decent economic outcomes that are holding this country, together socially. Because if you combine that with crap economic outcomes, then you've got a problem, like you've got in parts of the US.
Absolutely. Well, the point is you can have economic numbers looking reasonable, but quality of life continue to deteriorate. People having to work more hours to get by, all those sorts of things. And but I also agree with you that you got to measure the right things, right? And I'm afraid that the Chalmers attempt was pretty weak. But I do think there has to be a more mature debate about, what's the economy for, what's society for, what's the role of politicians in all of this. And unfortunately, at the moment, politicians, it seems to be about getting re-elected and, continuing to acquire your portfolio of investment properties. Did you see the research that came out, recently? The number of investment properties that politicians have is continuing to rise dramatically. So they're doing fine.
Yeah, I'm positively shocked. And I mean, I think the thing is, you combine that particular little fact with the fact that 70% of people believe that politicians are in it for themselves and not in it for the public. And then it's like, well, no wonder there's not a lot of trust there. No wonder, when people, you talk about housing around the barbecue, and not from a sort of investment property perspective, but just from a people need a home perspective.
Yeah.
Two very different barbecue sets. You best not get the two confused. But, you talk about that, and people are just like, well, why would politicians do anything? People just say, well, they've got investment properties, it's not in their interest to fix the problem.
Yeah.
And in fairness to people who have that particular opinion, well, we've got years and years of housing policy failure that basically just goes, well, they say we want cheaper housing, we want affordable housing, we want higher rates of home ownership. And it's like, well, you failed miserably on all three counts, yet you're going to keep pursuing the same policy. I mean, is that not literally the definition of insanity?
Well, it certainly is. But talking about insanity, we're at an hour and 15 already. So I think we're probably close to the end of our chat today. Is there any last slide that you want to share, or do you think we've...
No, I think we'll be right. And we shall can pick this up in next fortnight's program. Obviously, schedules permitting.
Yeah, absolutely. Well, we shall, certainly. And I want to say thanks, Tarric. I always enjoy talking with you about all the stuff that's going on, and perhaps trying to look at it in a slightly different perspective, because I actually think that the perspectives are really, really important, particularly now, and particularly in the environment. So thanks very much for all the work and all the charts, and I look forward to doing it. And yes, we'll do it in a fortnight's time.
All right. Looking forward to it, mate.
See you. Take care. Bye-bye.
You too, mate. Bye.